respected speaker for today's virtual CP seminar, our own young member, CA Sebin Mathew, Vice Chairman and Secretary, CA Shivrasad sir, immediate past Chairman, CA MC Jayaprakash, Treasurer, CA Dinesh K. Kumar, Managing Committee Member and past Chairman, CA Saju Sridhar, all the illustrious past Chairman of the Kannur branch, fellow members of the profession, friends and my dear students, a very good afternoon to all of you. Today we are delighted and extremely happy that our own member and young brother in profession, CA Sebin Mathew, is speaking on a very relevant topic on the related party transactions under the Companies Act 2013. It is very much the intention of the Institute to promote and encourage the young members of the profession, and we, in line with the same objective, were conducting seminars with our own young members as the speakers. During the last year, we had 4 such young members empowerment seminar, and this year also there will be a series of such programs in the month of June and July. Dear Sebin, we are extremely thankful to you for accepting our invitation, and on behalf of the Kannur branch of the SIRC of ICAI, I extend a very warm welcome to you to this virtual CP seminar of the branch. Welcome you, Sebin. I also extend a very warm welcome to all the managing committee members, all the senior members in the profession, friends, and to my dear students. Welcome you all. Members, please remember to fill and submit in the Google form, which is already shared in our WhatsApp group, to get the mandatory CP credit. Now I request CA Ashin Tom, another young member of the branch who is also getting ready as the speaker for another CP seminar, to formally introduce CA Sebin Mathew to the participants. Ashin, please.
Yes, sir. Good evening, everybody. Today we have the webinar topic on related party transactions, and I have got the opportunity to introduce before you a vibrant personality who is very much related to me, who is a very close friend of mine, whom I have met during the GMCS at Kannur during 2018 June. The best quality I have seen him is the ability to smile in tough conditions. He has passed out 12th from St. Michael's School, Kannur. Not just passed out, he was the topper in 12th as well as 10th. This brilliant man has showed his class and form and continued his winnings, consistency in winnings, and qualified CA at the age of 22 in May 2018. He has been holding COP from the year 2018. He is presently the partner at Chekapancho Chartered Accountants, Kannur, in charge of company audit and its compliance. He has already presented a paper on Companies Act in virtual platform for members of the Kannur branch of SIRC of ICAI. With this very brief description on today's resource person, I gladly and proudly introduce before you CA Sebin Mathew. Thank you.
Thank you, Ashin, for the nice introduction. Thank you. Now I request CA Sebin to proceed for the presentation. Sebin, please.
Today, on this afternoon day, I would like to bring to your notice a topic, related party transactions under Companies Act 2013. First of all, before we get to the main topic, why these related party transactions are regulated. First of all, we'll understand the background, why such transactions are regulated, and then we'll move on to the details of this section, and we'll understand each provision one by one. So why these regulations? Actually, while talking about the term related party transactions and the transactions covered under this terminology, is it like, are the related party transactions, are they rare, or are they illegal, or are they void altogether? So normally a question arises in all of our mind, whether this related party transaction, why so much like importance is given to such transactions, why so much regulations on such transactions. In the Companies Act, we have so many sections which prohibit certain transactions. Like we have section 53, which prohibits the issue of shares at discount. We have section 73, which prohibits the acceptance of deposit. we have section 182, which prohibits which controls the political party contributions. So is it like a prohibiting section? No. What is done in section 188, what we are talking about today, is actually a regulatory mechanism. When we talk about the related party transactions, it is very common in a business and in commerce. What makes or what brings such a transactions into a regulatory check or a transaction which have to be monitored? It's because the transactions are always with the related parties. So it has got a chance that the related parties involved in the management or the parties which are related, mean the management or the directors may exploit or make an abuse of their power what they have to get a favored treatment or a favored terms to get the transaction going on. It's like the related party transactions are easier to trigger than the other transactions because both the parties are non-parties, and certain transactions which are difficult to be triggered with the outside parties, we can easily manage to get it going if it is with a related party. So it's like a normal business practice only. And what the arising concerns are, apart from the management or the board of directors who are actively engaged in the day-to-day activities of the company, there are other stakeholders also who are not actively engaged in the business management. So if there is no regulatory check on what all transactions are getting executed within a company, it may get detrimental to their interest. So a regulation has been imposed on such transactions that such transactions will be monitored, such conditions has to be satisfied to get it triggered, and such other conditions are there. Mainly what happens is like the stakeholders which are outside the ambit of the business, they won't be able to know about such transactions. So these regulations bring all the details about the related party transactions and what all transactions are going to happen. It brings all those details on record so that all the stakeholders will be aware of such transactions and they can know what is going on in the company. That means it brings a transparency. By regulations, the government or the law, what they aim is to bring transparency among the transactions. So is it like a restriction mechanism? No. The regulations which is brought is only a regulatory mechanism to keep a check on transactions, that it doesn't become illegal or it doesn't affect the interest of other parties, or there is no abuse of power, because there is always a conflict of interest will be there in such transactions. Having said that, we'll move on to why such a topic. Or okay, before that, what all are the regulations imposed among different laws? We have Companies Act, what we are going to discuss it today. We have section 177, audit committee, and section 188, which is a major highlight of today's session. Section 188 dealing with the related party transactions and other secretarial standards and rules associated with that. These three items in the Companies Act keeps a check on these related party transactions. When we talk about the accounting standards, we have AS 18, the related party disclosures, and coming to INT AS, we have INT AS 24, which regulates or which monitors the transactions with the regulated parties. And the third one is SEBI listing or disclosure requirement regulations 2015. It keeps a check on listed companies, major check on listed companies. That means exclusively certain conditions or certain terms are brought out by SEBI, which is to be met by the listed companies. So these are the regulations which is put on by various laws over these particular transactions which are related party transactions. Having said that, we'll move on. And do we know enough? Like why this such a topic is important at this point of time. You can see 5 names on the screen, and we'll be definitely familiar with those 5 names. These 5 names are like 5 hot topics which was celebrated topics in the corporate field. Biggest fraud or scam which came to the limelight in our country. First of all, what happens in these frauds is, what leads to bringing all these into the limelight, into the public, is what generally when we go through all these scams, what we can see is either it will be because of the loans they have availed and their repayment capacity must have exhausted, or such other matters will be there, which causes those scams to be brought into the public limelight. So when after these scams are exposed to the public, investigations will be made, and after all the investigations made, what came as a common point among all these 5 cases, these 5 cases are just a matter of example. There are certain other cases also, or in almost all the cases, what we can see is in common is like the related party transactions. Their transactions with their related enterprises, the related parties. What they are doing is, in major cases, what we saw is the diversion of funds or the loans given to the related parties, improper records in related to the related parties, or the contracts or arrangements which got entered by this company, these 5 companies or the companies involved in fraud with the related party, which is very favorable, which won't be apart from this related party, they won't be doing those contracts or arrangements on those terms with outside parties. And all these cases, what we see, focus on the related party transactions. One way or the other, all these frauds will be related to the related party transactions, or the transactions these companies who are involved in fraud done with the related parties. So that brings, or that showcases the importance of the regulations, or the importance of the knowledge we should have about the related party transactions. After this fraud was investigated, Section 132 got implemented, NFRA came into act, and in all these cases wherever the auditor has been found misconduct, or a misconduct has been found from the part of auditor, the auditor has been debarred, or a cool-off period has been imposed on the auditor, or such further actions will be taken. So we need to understand what are the related party transactions, or how, or what all are the things we should note, or we should understand about the related party transactions. Moving on, the auditor perspective. That's the first thing we need to understand. Why such, before reading into the section or going deep into the section, what things or what details we have to get it from the section, why the auditor should be concerned about such section. In the company audit report order 2016, what is currently we are following, it's a question, like it's a single question, single clause. I think it's a clause 13 or something. The clause is like whether all transactions with the related parties are in compliance with section 177 and 188 of the Companies Act 2013 wherever applicable, and the details have been disclosed in the financial statements as required by the applicable standards. So that is a question set out by the CARO 2016. We'll split that question into 2 as what we see in the screen. First part is the compliance with the section 177 and 188 of the Companies Act. The question directly points out, it's not like a simple like whether one provision has been complied, or they are not highlighting, or they are not asking about a single transaction or something. They are asking, the law is asking the auditor to report or to present their comment whether the section 177 and section 188 are complied, and whether the required disclosures as required by the applicable accounting standard, that is AS 18 or Ind AS 24 in the companies who are required to follow Ind AS. So the required disclosures have been made in the financial statements as required by the AS. So this CARO 2016 brings a link between the Companies Act and the accounting standards. So this is the main reason why that section is important to the auditor. So whenever some issue arises or whenever some problem arises with related to the related parties or the related party transactions, automatically the attention will be gone to the point what we have disclosed in CARO 2016 CARO report. If we have reported that the compliance is proper, then automatically there is a misconduct from the part of auditor. So we'll talk about the disclosure, how we'll disclose the matter if anything comes to our notice while doing the audit. The format for disclosure we'll discuss at the end. So having said this introduction about this section, why this section is important to auditors, we'll move on to the section, what the section says. The Companies Act provisions, it is included in the chapter 12, meeting and powers of the board. Among with other 21 sections, we have got this section 188 and other sections which have a, what we say, a link to that section 188. It is section 177 deals with the audit committee. Section 184 deals with the disclosure of interest by the directors. Section 189 deals with the registers or records to be maintained. So these four sections in the chapter 12 forms a link to the main core section 188, which is the related party transactions. And the scope of section 188, what all things we'll discuss today. First of all, the meaning of the terms. Various terms and various provisions will be discussed. Certain terminologies will be there, which we may not be familiar with, or which is what we are familiar will be in the general perspective. We'll have a discussion on such terms, what those terms actually mean in the, what we say, in the aspect of Companies Act or say section 188 directly. And we have the procedural compliance. I mean, what is the flow of the transactions which we are monitoring under section 188? What is the approval procedure? What all procedures are involved? What is the transaction? How the transaction is happening? Who all are involved? What is the approval? And what is the, final reporting of those transactions? And lastly, the legal provisions. What is the outcome if we don't comply with this provision, or the legal penal consequence imposed or other consequences? So we'll be dealing all these things, all these three things, and which is under section 188. So first of all, before moving into the detail of the section, we have a related party. The section is section altogether, as the name suggests, the related party transactions. That's what the section is all about. And first of all, we will understand what is a related party. Apart from keeping about all the general aspect of what we have about the relative or a related party, we have a specific section in Companies Act 2013 which deals with the related party transaction or the definition of related party. It is dealt in the section 276. The definition section 276, we have got a definition for related party as per the Companies Act. The first one, a director or his relative. And second, the key managerial personnel or his relative. A firm in which a director, a manager or his relative is a partner. So first one is individual, second one is individual, third one we have a firm, an entity, which will be a related party as far as the company is concerned. Fourth one also, we have an entity, a private company in which the director or manager or his relative is a member or director. Fifth one it's a public company. This one is also an entity which becomes a related party if that condition is satisfied. It is a public company in which a director or a manager is a director and holds along with his relatives more than 2% of its paid up share capital. There is a slight amendment which was brought recently. Earlier, it was like a public company which a director or manager is a director or holds along with the relatives more than 2% of its paid up share capital. So replacing the terminology or with and brings down the applicability. I mean, how much wide we can go about that particular clause to bring a particular party into the ambit of related party. So the or is substituted by and after that, post that, like both the conditions are required to be satisfied to come into the ambit of clause 5. And sixth, any body corporate whose board of directors, managing director or manager is accustomed to act in accordance with the advice, directions or instructions of a director or manager. Simple as that. It's a body corporate. This also, the related party will be an entity whose board of directors or the managing director or manager, the board or the party, the individual who is engaged in the controlling of that particular body corporate is acting on the direction of a director or a manager of this particular company. Next one also, what difference is there between 6 and 7 is like, sixth one is the related party will be an entity, and seventh one, the related party will be an individual. If any person on whose advice, directions or instruction a director or manager of the company is accustomed to act, such person will be also brought into the definition of related party. What exception we have here is, if the clause 6 or 7, the directions which is given is in the professional capacity, then such person who is giving the direction need not be brought into the ambit of related party. That is an exception given within the section itself. And eighth one is any body corporate which is a holding, subsidiary or associate company of such company. That means the reporting company or the subsidiary of a holding company to which it is also a subsidiary, that is a fellow subsidiaries, or an investing company or the venturer of the company. So this is the eighth condition which brings another entity into the ambit of related party, and such other person as may be prescribed. So in respect of clause 9, we have a rule. The company's specific definition rule, we have another person also notified, that is a director other than an independent director or a key managerial personnel of the holding company or his relative with reference to a company shall be deemed to be a related party. So the director or KMP of the holding company or the relative of such persons will be a related party to the company, and such director shall not be an independent director. An exception has been given to independent director. So this is the definition of related party, what we have mentioned, what is covered in this section. And moving forward, we have said about the first two clauses. We have the director or his relative. Second clause, we have a KMP or his relative. What is the definition of the relative? The definition of the relative is given in section 277. They are members of HUF, they are husband or wife, and related person as prescribed under the Act. What is prescribed under the Act is given in the rule: the father, mother, son, son's wife, daughter, daughter's husband, brother, sister. And the step relation for all the relations, the stepfather, stepmother, stepson, stepbrother, stepsister. These are also included in the definition of relative. What is the interesting fact is that stepdaughter is not included in the definition of relative. So that thing alone is to be brought into the attention. Apart from that, what relative is individual relation that is displayed in the screen as the direct relation. There is no in-laws and all. This is just the direct relation: father, mother, son, daughter, brother, sister. So there is nothing more to that. And what is meant by KMP? It is mentioned in section 251. KMP means any CEO, Chief Executive Officer, or MD, Managing Director, or Chief Financial Officer, the company secretary, or the manager. So we have seen what is a related party, what all relations are mentioned in the related party, who all are the relatives, what is a KMP. So this is a basic for this section 188, because we will be mentioning related parties or and above everywhere. We'll be mentioning about the related parties. So the related party is always mentioned to what we have in the definition under section 276. Okay, moving on, we'll talk about the accounting standard AS 18. We'll go hand in hand, like we'll discuss the provision of section 188 and we'll discuss the comparative provision of section, AS 18. So under AS 18, what we'll first discuss is under the accounting standard, apart from the list of relatives or the related party, a more or less specific list of relationships are mentioned in the accounting standard 18. What all relationships will be covered for the purpose of disclosure. If any transaction are there within these relationships, it has to be disclosed. That is what AS 18 says. First one, the enterprise that directly or indirectly through one or more intermediaries control or controlled by or are under common control with the reporting enterprise. Putting it simple, the holding company, subsidiary company, or the fellow subsidiaries. That is what mentioned in that first clause. And the second one, the associates and joint ventures of the reporting enterprise and the investing party, respect of which the reporting enterprise is an associate or a joint venture. That is the second one. Third one, individuals. First one was an entity relationship. Second one was also an entity relationship. Third one, we have an individual relationship. Individuals owning directly or indirectly an interest in the voting power, which gives them control or significant influence over the enterprise, and relatives of such individuals. Third one, we have an individual relationship and the relatives of such individuals. Fourth one, also similarly, key managerial personnel and relatives of such personnel. And last one, the enterprise over which any person described in C or D, individuals and relatives, or KMP and their relatives, is able to exercise significant influence. So moving in detail to this particular list of relationships, we have what we see is the third clause. We have individuals having a voting power in the reporting enterprise that gives some control or significant influence. What is meant by this control? This control always refers to the power to control the composition of the board of directors, or they have 50% or more voting power in that particular enterprise. That is what we meant by control. And significant influence means they have an influence over the financial or operating decision making of an enterprise, or when we talk about the voting share, they'll be having over 20% of voting power will be there for such particular individual. Then such individuals will be brought within the such relationship will be brought within the ambit of AS 18. And key managerial person, the definition is very clear about any person, any person who is able to influence or make any particular decisions or operating decisions for the company, or any person on whose directions the board of directors is accustomed to act. So that person is brought into the ambit of AS 18, and the relationship or any transaction with such a person, key management personnel, will be covered under the AS 18. So this is about the AS 18, what are the relationships which are covered under AS 18. Any transactions which is happening between this relationship, within this relationship, it has to be reported. It has to be disclosed in the financial statements. It is an exhaustive list, and the AS18, what AS18 mentions about the relationships, only these 5 types of relationships are there, they are mentioning, and the transactions happening within these relationships alone shall be reported or disclosed in the financial statements. We have a comparison of AS18 and Section 188. Section 188, it is very specific. A specific definition is there for the transactions which are covered in the section. And AS18, it is mainly broad principles. Normally, our accounting standards are principle-based rather than rule-based, which is like US GAAPs. So the principle what we have applied here is the control and the significant influence. The definition what we have discussed earlier. Okay, the second point, we have Section 188, which is very objective, very clear about what all transactions are covered under Section 188. And AS18 always refers to a subjective principle. That means they are mentioning about only the relationships. Any transactions which is happening between such relationships will be covered under AS18. And regarding the disclosures, for Section 188, the disclosure requirement is like all the transactions which are coming within the ambit of Section 188, that is wherever Section 188 is getting hit, we have to report it in the AOC2, which is annexed to the board report. And in respect of AS18, the disclosure will be made in the general purpose financial statement. That will be it in the notes to accounts. And the fourth point, the compliance and disclosure. The compliance is required for each transactions. Whenever we enter into a transaction which is coming within the ambit of Section 188, we have a compliance procedure, what we'll be discussing later. So it is like a concurrent compliance procedure. Whenever the transaction happens, we have a set of compliance procedures we are supposed to follow. And disclosure, it is definitely at the year end. And with regard to AS18, the disclosure, it is only required at the end of the year. When we prepare the financial statements, we'll have a set of disclosure requirements what we'll be following. And in the Section 188, the Act is very specific about the provision. What is there? There is no disclosure required if no related party transactions are entered. I mean, if no related party transactions which comes within the ambit of Section 188, the company is not required to disclose anything. Whereas in AS18, even if there is no related party transactions or there are no transactions which between the relationships which we have seen, even though there are no transactions, the AS18 requires the disclosure of the disclosure regarding the names and other parties with whom there is control exists. I mean, apart from the related party transactions, even if there is no related party transactions happened during the previous year, we need to mention a list of all the enterprise where we have control or they have control over us, like holding company, subsidiary company, associate, joint venture. All those details need to be disclosed in the financial statements. That is, even if the transactions are not there, leave everything apart, we need to disclose one matter compulsory in the financial statements if there is something like that, like there is a control or there is a controlling entity, we are a subsidiary of another company, we need to disclose the name of the holding company in our financial statements. So this is the comparison of Section 188 and AS18. So we'll move on to the details of Section 188, the core area of today's discussion. What is happening in Section 188? What is a related party transaction? What is a flow of transaction? The company, I mean the reporting entity, enters into a contract or an arrangement with the related party. This is the one line of what is happening within the related party transaction. A company is there; it will be entering into a contract or arrangement with a related party. Who is the related party? We have already seen. The company is a reporting entity. And what is a contract or arrangement? A contract or arrangement means a contract always refers to a formal or written arrangement. I mean, a formal or written form of transaction. Will be having a written evidence for the transaction, or a formal communication will be there as to the happening or the triggering of such a contract or such a transaction. Whereas in the arrangement, it is mainly like informal or orally communicated transaction, keeping it somewhat way like we have a contractual obligation. If it is a contract, in respect of arrangement, we have a constructive obligation. We have the meaning of obligation mentioned in AS 15 and AS 29. And in respect of arrangement, we'll have a constructive obligation. And in respect of contract, we have a contractual obligation. So the main thing is the contract will be formal and arrangement will be informal. Contract will be written and arrangement will be orally based. That is the main difference between contract or arrangement. So bringing all the definitions together, we have any transaction, any sort of transactions between a company or a related party. If it comes within the transactions listed in section 188, we are bound to follow the compliance and approval procedures. That is all meant by a contract or arrangement. So what is the transaction covered under section 188? This is the flow of transaction, and as per the act, there is a multiple side for this nomenclature. We call it related party transaction, and there is a case where transaction with a related party. Hearing both together it sounds like a similar phrase. Or a related party transaction and transaction with a related party. It sounds like a similar phrase, but as per the act, it both has a different meaning altogether. That means the transaction with a related party need not be a related party transaction, but related party transaction will be a transaction with a related party. So what is related party transaction? The transactions which are covered under section 188. So what we can derive from such a phrase is that all the transactions with related party are not related party transactions. If a particular transaction is to be set as a related party transaction, it has to be one among the list of transactions which are mentioned in section 188, what we are going to talk about next. So the related party transaction, what we have already said, we'll have a comparison of section 188 and AS 18 will go hand in hand. And what the related party transaction as per section 188 we have seen. And what is the related party transaction as per AS 18? The transfer of resources or obligation. That is what is happening or what is covered in AS 18. Transfer of resources or obligation, whether or not price is charged. It brings a wider applicability to the transactions which are brought into the ambit of AS 18, whether or not price is charged or transfer of any resources or any obligation. So that is what mentioned in AS 18, the transfer of resources or obligation, whether or not price is charged. This transaction has to happen between related parties. So what is related party? Earlier we have seen what all relations are covered under AS 18. So, and what is the related party transaction we are mentioning about? And this transaction has to be between related parties. So what is the related party which is mentioned in AS 18? We have already seen the definition earlier, but quoting again, the related parties are those parties who has got any time during the reporting period, one party has the ability to control the other party or exercise significant influence over the other party in making financial or operating decisions. So that is the definition for related party. It is a general definition. It is nothing like a specific definition and all. Since it is very general in nature, a wider applicability is there for AS 18. So what is mentioned is one party should have the ability to control the other party. That means the control we have already seen, ability to control the composition of the board of directors or 50% of voting power. In either of the cases, a party is said to have control over the other party, and or the party is having like power to exercise significant influence over the other party. That means the party should be able to influence other party in taking financial or operating decisions, and bringing it on the terms of shareholding. A minimum 20% shall be sufficient. So when these conditions are met between two parties, they are said to be related parties. And any transfer of resource or obligation between these related parties, whether or not price is charged, it comes within the ambit of related party as per AS 18. So we have seen what are the related party transactions covered under both section 188 and AS 18 on a general perspective, and the specific list of transactions which are covered under section 188. That is what we are going to see next. So we have here is a exhaustive list. First we'll read out all the transactions which we have here. First one is sale, the purchase or supply of any goods or materials. That is the first item which is there in the list, the exhaustive list done by the Companies Act. Sale, which we can refer it to the sale of like stock in trade, or supply we can always refer to what made to order. So all the transactions, sale, purchase or supply of any goods or materials are covered in the first transaction. We can call it as the transactions involving movable items. Okay. And second one, we have the transaction of selling or otherwise disposing of or buying property of any kind. Since the terminology property has been used, we can always refer to this as the transactions involving immovable properties. First one, we have the movable properties. Second one, we'll take it as the transaction involving immovable properties. Third one, leasing of property of any kind. That means the transaction involving rent paid or rent received. Fourth one, we have availing or rendering of any services. That means we have availed a services, or we are rendering any service. Both these transactions will be covered under section 188. And fifth one, appointment of any agent for purchase or sale of goods, materials, service or property. That means what we have seen in the above four clauses, even if it is carried out through an agent, that also will be covered under section 188. Sixth one, the related party's appointment to any office or place of profit in the company, its subsidiary or associate. That is a sixth transaction. And seventh transaction, the underwriting the subscription of any securities or derivatives thereof of the company. That means a commission will be paid in respect of such a transaction. So we have got an exhaustive list here. The 7 transactions. Section 188 only talks about these 7 transactions. Whenever such a transaction is happening, section 188 gets triggered, and we'll deal with the what all other conditions have to be met. Prima facie, section 188 deals only with these 7 particular transactions. So these 7 transactions with a related party, what we have seen under section 276, if such transaction is happening, it has to be brought within the ambit of section 188, and all the conditions and other compliance procedures what is mentioned in section 188, the company is supposed to follow. Having said the transaction list of what is covered under section 188, we have a sample list of what is excluded from section 188. First one will be having like issue of shares. Such transaction is covered under section 42, section 62, and section 72 of Companies Act, or the preferential allotment of shares, the providing of guarantee, providing security, giving loan, investment. All these transactions are of the financial nature. So there are separate sections governing the transactions involving, the sections to govern the procedures involving such transactions. We have section 185, section 186, and we have talked about the issue of shares. We have section 42, 62. So they are covered, exclusive sections are there to govern those transactions. So these transactions are not covered under section 188. Section 188 only refers to the above mentioned 7 transactions alone. These transactions, even if with a related party, it won't be covered under section 188. That is where the earlier phrase comes into effect. The transactions will be with the related party, but it won't come into the ambit of related party transaction. And we have a circular 30/2014, which exclusively says that the compromise arrangements or amalgamations, such a transaction won't be covered under section 188. And that circular also lists out that the prior period contracts, contract or arrangement, what we have mentioned earlier, the contracts which was entered prior to the coming of Companies Act 2013, what all contracts which we have entered before, and the terms which are mentioned in such contracts will be continued, or such transactions will be excluded from section 188 till the expiry of the original term. That is what mentioned in circular 30/2014. 2 transactions has been excluded specifically. One is compromises, arrangements, and amalgamation. Second is all the contracts which was entered prior to the implementation of this section. Such transactions will continue to be excluded from the ambit of section 188 until the expiry of term. Another one is buyback of shares, which is governed by section 68. What we have seen in section 188 is a contract or arrangement between the company and the related party. Buyback of shares altogether is a scheme. So that need not be brought into the section 188 ambit, and the compliance procedures or other procedures in respect to section 188 need not be followed in case there is buying back of shares. So we have seen what is included in section 188, what is excluded from section 188. And when we are talking about the transactions covered under section 188, there are various terms. Okay, various terms were there, which like I told in the beginning itself, certain terms are there which we may be familiar in the general perspective, but we need to know, talking about or discussing about section 188, we need to know the meaning of such terms with respect to section 188 or with respect to related party transactions. What is actually meant by such terms in the ambit of section 188? So the certain terms which have a special or special importance in complying with section 188, we have listed out certain terms. That is the ordinary course of business or arm's length transactions. We have not discussed about any provision involving these 2 terms, but what comes next? What is important with regard to the compliance procedures always involves those 2 terms, ordinary course of business and arm's length transaction. We'll be hearing a lot more about those 2 terms. We'll be hearing provisions involving those 2 terms a lot. So we'll have an idea of what those terms means before going into the provisions involving such terms. What is meant by contract or arrangement, apart from what we have heard earlier, in the general perspective, what is a contract or arrangement? What is meant by goods? The first clause of section 188, and what is meant by services? Clause 4 of section 188, subsection 1, and office or place of profit, clause 6 of section 188, subsection 1. So we'll have an understanding of these terms. We have heard what the transaction is, and these terms are included in those transaction lists, but we'll have a discussion on what the actual meaning of these terms when it comes to in relation with section 188. First of all, that is what these terms are not defined in the act. That is the main issue here. These terms, if we have a specific definition for each terms, we need not bother about that. We'll take it directly from that specific section. We'll extract that, we'll find and we'll get an understanding of such terms, and we'll use it wherever necessary. The issue is that these terms are not defined as such in the act. So what we are going to do here is we are going to derive the meaning of all these terms either from case studies, the court orders, or other applicable acts. Apart from Companies Act, we have several acts like GST, Competition Act, General Clause Act, Sale of Goods Act. So many type of act which are prevailing currently among the law, we'll derive the meaning what we have there, and we'll discuss with that perspective. The transactions which are listed under section 188, the terms which are mentioned there, will derive a meaning from other act or the applicable act or other court orders or other dictionary meanings which we find or the act find meaningful in a particular scenario. So first one is ordinary course of business. That is a general meaning. General meaning is like what is mentioned in the dictionary. It's part of a regular business, a regular or a customary condition or course of things as usually happens. That is what mentioned in the dictionary. That is the meaning of ordinary course of business mentioned in the dictionary. For the phrase. And we have Black's Law Dictionary, which gives a definition for ordinary course of business as the normal routine in managing business or trade. That is the definition which is given in the Black's Law Dictionary. And while talking about the phrase ordinary course of business, from a layman's point of view or a common parlance, it includes normal course of business, generally for promoting or furtherance of business as per charter documents. Charter documents often refers to the memorandum of association or articles of association of the company. And what business is mentioned in such documents. So whatever transactions we are undertaking, it becomes ordinary course of business if it is generally for promoting or furtherance of business. That is a common phrase, general aspect for this phrase, ordinary course of business. The factors to be considered. We have a few factors. This is not an exhaustive list or like what is mentioned in the law. It's like we have a guidance note from the Institute of Company Secretaries of India on related party transactions. As per the guidance note of the institute, we have certain factors which has to be considered or which can be considered while deciding a particular business is in the ordinary course of business or a particular transaction is in the ordinary course of business. First one is whether the transaction is covered in the object clause of memorandum. It is very clear about that, whether such a business is covered in the object clause, whether such transaction or business is in furtherance of the business of the enterprise, or is it normal or otherwise routine for the particular business. It's like we'll be taking each transaction or each course of business separately, and we'll be comparing whether this business is in the furtherance of our normal business procedures, or this business is part of a routine of a particular business, or the business we are talking about, is it repetitive or frequently happening in our enterprise or company. So these factors can be considered. It is always contextual or subjective information. It's nothing like exhaustive list, or there is nothing like which pinpoints that this particular transaction is in the ordinary course of business. It is always subjective, or it differs from case to case. And the other factors also, whether the income, I mean, a particular transaction or a business is being carried out, and the business will obviously derive income from such a transaction, and whether such income is treated as a business income. This factor also can be considered. Next one is whether the transactions are common in the particular industry in which the business is existing, whether the business we are talking about is common in that particular industry. This is also another factor which can be considered. Next one is whether there is any historical practice to conduct such activities. That is, in the earlier years, whether we have conducted such activities which was put as a normal ordinary course of business. If that is the case, automatically what the business which we are talking about comes within the ambit of ordinary course of business. The financial scale of the activities with regard to the operations of the business, the revenue generated by the activity, the resources committed to the activity, all these factors will help the company or the board to understand or to get into a conclusion whether a particular business about which we are talking is in the ordinary course of business. So these are, as I already mentioned, is not an exhaustive list. Always, in case whether one business is ordinary course of business in respect of a particular industry, that need not be the case when it comes to in respect of the other industry. So it's always factual. It differs from case to case. Moving on, who decides the nature of the business transaction? So what we have already seen, the factors which can be considered to derive whether the business we are talking about is in the ordinary course of business. Who decides? Who is the deciding authority? We can have the board in case where the company is required to form or to exit. I mean, in case where the company is required to form an audit committee, the audit committee can decide the nature of the business transaction, or the board of directors, in absence of audit committee, the board of directors, the board may decide whether such transaction what we are discussing about is in the ordinary course of business or not. It will be either based on the books of account, I mean the policy of the company, or it will be based on the normal practices of the company, or the parameters set by the board of directors itself, or the guidelines which is formulated by the company, by the board itself. We have a few case studies wherein case studies on Bharati Televentures. We have a case where the transactions mentioned in the memorandum of association need not be in the ordinary course of business. What we will be discussing about, what is mentioned in that particular case study is that the frequency of the transaction or the repetitiveness of this transaction has to be taken into consideration. Another case also, we have a similar line of approach, like mere inclusion of a particular transaction in the memorandum of association doesn't bring such transaction within the ambit of ordinary course of business. So there is no particular thumb rule for deciding whether a particular transaction is in the ordinary course of business. We have to decide based on case studies. I mean, it differs from case to case. Factual facts of each transaction have to be understood whether before deciding whether it is in the ordinary course of business. We have standards on auditing 550, which talks about the related parties. In the paragraph 825, SA 550 has listed certain examples of transactions outside the entity's normal course of business. So these transactions, like 6 in numbers, they are normally outside the scope of ordinary course of business. That is what SA 550 says. Normally, these transactions will be outside the ordinary course of business. Even though SA 550 says like that, like these 5 transactions are outside the ordinary course of business, we have to take it case by case, and we have to examine each case separately. The list of the examples are complex equity transactions such as corporate restructurings or acquisition. They won't be, they are not supposed to be included in the ordinary course of business, except for any like major changes or major factors which pulls it into the ordinary course of business. Next one is transactions with offshore entities in jurisdictions with weak corporate laws, the leasing of premises or the rendering of management services by the entity to another party if no consideration is exchanged, sale transactions with unusually large discounts or returns, the transactions with circular arrangements, for example, sales with a commitment to repurchase, transactions under contracts whose terms are so these 6 transactions are excluded from the ambit of ordinary course of business as per SA 550. So we'll keep this as a base whenever such a transactions comes into consideration. We'll have a check on that, and what we have seen in SA 550, what if that proves to be correct, it will be directly put out of the ordinary course of business, and it won't be covered under section 188 also. So that is talking about in section SA 550, the transactions which are outside the scope of normal course of business. And as per the guidance note of CARO 2016, which is published by the Institute of Chartered Accountants of India, we have certain factors, certain deciding factors which can be considered while deciding whether a particular transaction is in the ordinary course of business or not. Like we are already seeing, the first one is whether it is covered in the objects, whether the transaction is usual or unusual, both from the company and its line of business, whether the frequency of the transaction, whether transaction is taking place at arm's length, the business purpose of the transaction, whether transaction is done on similar basis with other third parties, and size and volume of transaction. Going through these deciding factors, what we can understand is the management must have already classified a particular transaction, whether it is in the ordinary course of business or not. The auditor, while reporting in CARO 2016, will take these factors as a deciding factors to decide upon whether a transaction is in the ordinary course of business or not. As we have already seen, these are just factors. These are it is not an exhaustive list. It is just an example to aid the auditor in deciding whether a particular transaction is in the ordinary course of business. And moving forward, we have next nomenclature, arm's length price. We have a general meaning as per section 180, explanation to section 188.1. We have a meaning that arm's length transaction as a transaction between two related parties that is conducted as if they were unrelated, so that there is no conflict of interest. In the beginning itself, we are talking about the conflict of interest. Why this section is important? Because the transaction will be entered between two related parties, and there is always a chance of conflict of interest coming in between, and it may affect the transparency of the transaction. So we have got the arm's length price. What it means by the arm's length price or basis is like what is meant by arm's length transaction, which we have seen, and we have to decide whether a particular transaction is on arm's length basis. So by talking about arm's length basis, it need not mean arm's length price altogether. The transaction as a whole and the entire bundle of the terms and conditions needs to be considered for determining whether the transaction is on an arm's length basis. So we have seen what is an arm's length transaction. Two related parties, transaction between two related parties as if they are unrelated. And what is arm's length basis? It's not about the price which is quoted. It also includes other terms and conditions which are to be considered before determining whether the transaction is on arm's length. So moving on, it is always like arm's length price or arm's length basis. We always put our concentration or the decision making just on the price. It is not the price. It is always other terms and conditions also need to be addressed, that they are not unfavorable, or it is normally those terms and conditions are on par with the terms and conditions executed in the transaction with other parties also. So in such cases, the transaction will be on arm's length basis. So do we have a separate mechanism or an exclusive mechanism to identify the arm's length basis? As per Companies Act, there is no such mechanism. We'll take a mechanism from the Income Tax Act 1961. The arm's length transaction under Income Tax Act 1961 refers to section 92F. That means the section of transfer pricing. Section 92F of Income Tax Act 1961. Arm's length price means a price which is applied or proposed to be applied in a transaction between persons other than associated enterprises, that too in uncontrolled conditions. That is what mentioned in section 92F of Income Tax Act. That is a transfer pricing mechanism. The transfer pricing mechanism, we have a list of methods or procedure we can apply to derive to understand whether a particular transaction is on arm's length basis or not. So the methods used are comparable uncontrolled price method, resale price method, cost plus method, profit split method, transactional net margin method. These are the 5 methods which is mentioned in the provisions of transfer pricing, and we'll take that provision, we'll take those mechanisms for the purpose of deriving whether a particular transaction is on arm's length basis. We'll take these 5 methods to apply against a particular transaction, and we'll understand whether after applying these 5 methods, what the suitable method, we'll understand whether a particular transaction is on arm's length or not. Why we are depending upon the methods which are mentioned in the Income Tax Act? The guidance note on CARO 2016 refers to the methodologies or processes involved in the transfer pricing mechanism to derive at the arm's length basis. So there is a legal base for such a selection. That means selection of transfer pricing mechanism or incorporating transfer price mechanism into section 188. We have a legal base. So these 5 methods can be used. And other examples like appointment and remuneration of director, we have a separate section covering section 178. If that committee is bound to be formed, we have section 178. We have section 197 schedule 5 to deal with the remuneration of directors. In transactions where sale, purchase or supply of goods or materials, we will take we'll derive the arm's length price using the mechanism which we have already mentioned above. That means the methodologies used in transfer pricing mechanisms. And talking about the proof that a particular transaction is on arm's length basis. To demonstrate the absence of conflict of interest. That is the main thing. We have to demonstrate, or we have to prove that the conflict of interest or the special relationship between the parties involved in the transaction doesn't affect the price, the quantity or quality which is involved in the transaction. That is, we have to prove, the party is liable to prove that the conflict of interest is absent in such cases. So in order to prove that the particular transaction is on arm's length basis, we have a mechanism over there, and by using those mechanism, we'll check whether any influence have been placed, or any terms or any conditions have been imposed which are favorable to a particular party. So by that basis, we can arrive whether the particular transaction is on arm's length or not. Should every transaction be accompanied with a certificate from a valuer? That means we have seen that each particular transaction will be evaluated based on some methodologies or approaches. So the question is whether every transaction should be accompanied with a certificate from a valuer. It is not required as such. We have comparable market price method, where a particular transaction will be compared with another transaction with a third party, where we can understand, or where we can conclude that such a transaction is on arm's length basis. But on a safer side, if you are able to get a certificate from an internal auditor or the management or those charged with governance, that certificate stating that such and such transactions are on arm's length basis, will be on a safer side, and we can conclude, we will have a conclusive evidence that a particular check has been made on such transactions, and all these transactions are on arm's length basis only. What are the parameters to be considered by the audit committee while considering whether transaction is on arm's length basis? And there is no particular specific parameters to be considered. It is all factual or subjective. Audit committee will take into consideration several factors, the policy of the company, or the other certificates what we have mentioned above, the certificates they have obtained. The audit committee, apart from giving recommendations, will be more focused on giving specific approval for a particular transactions. So there is no specific parameters as to what all are things to be considered to arrive at the arm's length price. It is also different from case to case. Separate mechanism or methodologies can be applied on several transactions also. Next one is contract of arrangement. We'll have a meaning of arrangement from separate laws, other laws. We have the Competition Act 2002. Under the Competition Act 2002, the arrangement is included in the meaning of agreement. So what is meant by arrangement is such arrangement may be formal or informal, oral or written, and may also be a concerted practice. That is a part of earlier practices. We have Companies Act 1956, Section 390 was there, the replica of Section 188. In a specific, in a old case study, the court, while observing the meaning of arrangement under Section 190, it has come to a conclusion that arrangement means to come to an agreement or understanding or an action of arranging, or an agreement or understanding between a related parties. That is what is meant by arrangement as per an old case study. The next definition of arrangement is also taken from an old case study, which the court has mentioned about a case in the opinion of an expert group giving an expert opinion on the term arrangement. Arrangement means any scheme, trust, grant, understanding, covenant, agreement, disposition, transaction, and includes all steps by which it is carried into effect. So by these terminologies or these explanations, we have this idea of what arrangement means. We can say like an agreement or understanding. between related parties or an action of arranging. That is can be understood from a common perspective. And we have goods. The first clause we had the first clause under section 188, sale, purchase, or supply of goods or materials. What is meant by goods? In general meaning, in the Sale of Goods Act 1930, we have a meaning for goods as any movable property other than actionable claim and money. And in the General Clause Act 1897, we have the meaning as every item except immovable property. And in case of CGST Act 2017, we have a meaning every movable item, movable property other than money and securities, but includes actionable claims. So going through all these definitions of various acts, we can conclude that what is meant by goods is actually movable items, or the immovable properties is totally excluded from the definition of goods. So the first clause of section 188 clause 1, the clause A of section 188.1, we have the transaction as sale, purchase, or supply of goods or materials. And what is meant by goods? It is more or less, it only refers to movable items. And in respect of services, we have clause 4, clause D of section 188 subsection 1, availing or rendering of services. What is meant by services? Philip Kotler, the father of modern day marketing, as per his definition, a service is an act of performance that one party can offer to another that is essentially intangible and does not result in the ownership of anything. That is what is meant by services. And the sixth clause, we have office or place of profit. General meaning, an office or place of profit means an office or place or position which gives the person holding such office some pecuniary gain or advantage or benefit. Moving into the section, we have mentioned what is mentioned in section 188 subsection 1, any office or place where such office is held by director if he receives a remuneration over and above the eligible amount, then such place comes within the ambit of office or place of benefit. Or in case of any individual other than director or any firm, company or body corporate receives from the company anything by way of remuneration, salary, fees, commission, perquisites, any rent-free accommodation or otherwise. That is what is meant by office or place of profit. That means a director, if he derives any benefit over and above the remuneration, and any other individual who receives from company any sort of remuneration, whether it can be salary, fees, commission, or such type of income from the company. That is what is meant by office or place of profit. So the company or board should always ensure that any person who is appointed in the fiduciary position of a company should not derive any benefit or any benefit without the prior approval of the board. He should not be allowed to exploit the position and to derive excess benefit over and above what he is eligible of. So that is what is meant by office or place of profit, and that is why a check has been made in the section 188 for such positions where the directors and other individuals are being placed. That is to ensure that no excess benefit or no excess advantage has been derived by such persons for the simple reason that he is being placed there or he is a related party. So to avoid that, a separate check has been made on such positions. Before moving on to audit committee, we'll have an understanding of the board process. What is actually happening? Why we have discussed all these nomenclatures, we have discussed various provisions. Why or where does these terminologies or provisions fit in? That is what we are talking about under the board process. under the scope of section 188, we had understanding the meaning of terms. Now we have the approval procedure, the procedural compliance. What is said in section 188(1)? A company cannot enter into the contracts or arrangements as mentioned in section 188 with its related parties without the approval of its board or directors at a meeting of the board. So it is clear. The section directly says that the company cannot enter into the contract or arrangement with its related parties without the approval of the board of directors. That is what the section says. And we have an exception to that. The approval what we have mentioned above, approval of the board of directors is not required if the above mentioned transaction, that means the contract or arrangement between the related party, is an ordinary course of business and the transaction is at arm's length price. So if these two conditions are satisfied, the company or the company need not get an approval from the board of directors, and such transactions won't be covered under section 188. That means that any transaction, any contract or arrangement between a related party at in the ordinary course of business at arm's length price, for such transactions, a prior approval of the board of directors is not required. Means if it is in the ordinary course of business and at arm's length prices, it totally goes out of the ambit of section 188, and there is no specific approval required from the board of directors perspective. And if it is not, if either the transaction is not in the ordinary course of business or the transaction it's not at arm's length basis, the approval need to be obtained from the board, and approval to be obtained should be through an ordinary resolution at the meeting. And suppose if prior approval is not obtained, is there any chance of ratifying that? Yes, section 188 provides that the ratification should be done within 3 months. If the transaction is carried out without obtaining prior approval, that ratification should be carried out within 3 months, and that particular transaction should be brought within the ambit of section 188, and that should be made legal. That is meant by what ratification is. And in case where any director is interested or is a related party to any contract or arrangement, such director shall not be present at the meeting. So that is the point here. Any director is interested in any contract or arrangement with a related party, such director shall not be present at the meeting. An exception has been given to private companies. In case of private companies, the director can participate in the meeting after disclosing his interest. We have a separate procedure for the disclosure matter. The director can participate in the meeting after disclosing his interest. The independent director is wholly responsible for the conduct of the meeting. The independent director should he should ensure that all the details have been passed on to all the directors, and adequate deliberations has been made, and the transaction which is being carried out is in the total interest of the company. That thing, the independent director has to be taken care of. So that is about the board procedures. And the agenda of the board meeting at which the resolution is proposed to be moved shall disclose the following. Following things has to be included in the agenda of the board meeting: the name of the related party, the nature, duration of the contract, the material terms of the contract, the advance paid or received, the manner of determining the pricing and other commercial terms. That is how the board has come to a conclusion that particular transaction is at arm's length, or is it in the ordinary course of business. Such details are also required to be mentioned. Whether all factors relevant to the contract have been considered If not, the details of factors not considered should be also mentioned in the agenda and any other relevant information. So these many details has to be mentioned in the agenda for the meeting where such transaction will be placed. So that's about the board process. And talking about the process involving shareholders. When does the shareholders comes into this activity, or when does the shareholders importance comes in the section 188? We have seen the transactions or the contract or arrangement in the ordinary course of business and at arm's length prices need not get an approval of the board of directors. The board of directors need to approve the transaction only if such transactions are not in the ordinary course of business or are not in the arm's length basis. So when does shareholders comes into the picture? These are the transactions which gets covered under section 188. The sale, purchase or supply of goods or materials, selling or otherwise disposing of. We have 6 type of transactions there. And in the section 188, it is mentioned that a particular limit has been kept or a particular benchmark has been fixed for all these transactions. That means a normal, we have talked about the arm's length prices. If there is any deviation or if the transaction is not in arm's length price only, then the board of directors comes into place. And if that deviation exceeds a particular limit, then the shareholders comes into place. That is what is happening. Take the first case, the sale, purchase or supply of goods or materials. It is not in the arm's length price or not in the arm's length basis, and the deviation exceed 10% of the turnover of the company, then the shareholders are required to act upon, or shareholders are, an approval has to be obtained from the shareholders to transact such a transaction. Means that the transactions covered under section 188, if not in the ordinary course of business or arm's length prices, if the transaction value exceeds the threshold limit, the threshold limit is being exceeded, then such transactions also requires an approval from the shareholders. From the general meeting, an approval has to be obtained from the shareholders. Earlier, the threshold limit was, in the first case, the threshold limit was 10% of the turnover or 100 crores, whichever is lower. In the 2019, that gross limit has been removed. The gross limit has been removed for the purpose that in bigger enterprises, that is MNCs and other enterprises, which have got daily transaction or above 100 crores and all, for all the transaction or each transactions with their related parties, they need to get the approval of the shareholders. For that particular reason, that gross limit has been removed, and we have a threshold limit only in respect to the percentage of turnover or net worth. We have here, first one, it talks about whether the sale, purchase or supply of goods or materials from the related party exceeds 10% of turnover. Selling or otherwise disposing or buying property of any kind exceeds 10% of the net worth. Leasing of property, we have another threshold. Availing or rendering of services, we have another threshold. Appointment to any office or place of profit in the company, subsidiary or associate, we have another threshold. That is a monthly remuneration should not exceed 2.5 lakhs. If it exceeds 2.5 lakhs and it is not on arm's length basis, then normally automatically the shareholders' approval need to be obtained. And the last one, underwriting the subscription of any securities or derivatives. We have a limit of 1% of the net worth. So these are the threshold limit. These are the limit which we need to consider to identify whether a particular transaction need to get approved from the shareholders or not, or whether we just need the approval from the board alone. Okay, So in case where shareholders approval is required, automatically such cases will be requiring board approval also. All the above listed cases where threshold limit is breached, prior approval of the shareholders is required. That is what said in the Act. Instances where prior approval not required mean the exceptions. In case where the transaction is between a holding company and its wholly owned subsidiary, the resolution passed by the holding company shall be sufficient. We need not get approval from both wholly owned subsidiary and holding company. The resolution passed by the holding company shall alone be sufficient. In case where holding company and the transaction between holding company and wholly owned subsidiary, prior approval not required if the accounts of this holding company and wholly owned subsidiary is consolidated and put for approval in the general meeting. In such cases, prior approval of shareholders not required. And also in case of government companies, when the contract or arrangement is with another government company, or in case of unlisted government companies, whether prior approval has been obtained from the ministry regarding that particular transaction, in such cases also prior approval of shareholders are not required. As we have seen in the details which are required to be disclosed in the agenda for the board meeting, we'll be having an explanatory statement to be annexed to the notice of the general meeting, and such explanatory statement shall contain the following. It shall contain the name of the related party, the name of the director or KMP who is related, the nature of the relationship, the nature, the material terms, monetary value, and particulars of the contract or arrangements, and any other information relevant or important. So these many details are required to be incorporated in the explanatory statement, which is to be annexed to the notice of general meeting. The purpose of this is that the members or the other shareholders will get a proper understanding of the transaction which is going to be approved at the meeting. So all details which is required to be what all details need to be told to the shareholders, we will incorporate it in the explanatory statement, and it shall be annexed to the notice of the general meeting. And the shareholders process, no member of the company shall vote on such resolution to approve any contract or arrangement which may be entered into by the company if such member is a related party. So that is a general provision. No member, it is a proviso to section 188. The proviso is saying like that, no member of the company shall vote on such resolution to approve any contract or arrangement which may be entered into by the company if such member is a related party. That is a proviso. We have a specific exception to the proviso, that this proviso, an exception has been given to private limited company to comply with such proviso, and exception has been given to unlisted public company licensed to operate by RBI or IRD or SEBI. Such unlisted public company is also given an exception to meet with the above said proviso, and the government company. The government company which is mentioned here is a government company who is engaged in the contract or arrangement with another government company, or an unlisted government company who has obtained prior approval in respect of a particular transaction. So this exception has been given, but this exception, what we have seen, is purely conditional. What the exception we have seen in case of approval by the board also, that is in case of private company, the director can disclose their interest and they can participate in the board meeting. Such an exception is also conditional. What is the condition? The MCA notification dated 13 June 2017 gives a condition to avail this exception. That is, there should not be any default under section 137, that is filing of financial statements, and there should not be any default under section 92, that is filing of annual return. Only if the company meets these criteria, that is there is no default under section 137 or 92, then only the private company or other companies which are eligible to avail this exception, then only they can avail the exception. That means the exception that the interested director can participate, or the related shareholders can participate and vote. These two exceptions can be availed only if the section 137 and section 92 has been complied with. That is the shareholders process. And what are the disclosure requirements in respect to related party? Disclosure requirement of directors. Every director or KMP is required to inform the board of directors the list of relatives along with their PAN, and the directors and KMP are required to update that details or list periodically whenever a change occurs. And when should a director inform the board of directors? When to disclose? That is a question. It is said that the director is required to disclose, and when to disclose. The director is required to disclose the interest or relations or the related parties, details of related parties in the first board meeting after which he becomes a director, or if there is any change happening, it should be intimated to the board of directors within 30 days or next board meeting, whichever is earlier. In case of KMP, he should inform the board the details of his interest or his related parties within 30 days of his appointment. So that is the time limit within which the disclosures shall be made. And the register to be maintained, the company is supposed to maintain a register on all the details. Register should be maintained under section 189, and all the details of this related parties or interest should be incorporated in that registers. And voting summary, what we have already seen, interested directors at board meeting, they can disclose interest and participate, provided we have an exception condition there that to comply with section 137 and 92. In case of public company, there is no such exceptions, and the interested directors cannot participate. In case of interested members at the general meeting, they can vote in ordinary resolution, provided the exception condition are met, that is section 137 and section 92 are complied with. And in case of public company, the interested members cannot vote in ordinary resolution. Only one exception is given in case of public company, where the 90% or more members are related parties in respect of a particular transactions, then they can vote in respect of that particular ordinary resolution. That is what mentioned in the Act. This is an overall summary of the voting. And the disclosure requirement, what is required by the Act. What is required in the Act is that the disclosure requirement is mentioned in section 134, which covers the board report, and we have an annexed statement in the form AOC2, and the details of these transactions will be mentioned in the AOC2. That is, the particulars of contract or arrangements with the related parties will be disclosed in the AOC2 form. And what all are the details to be disclosed in the AOC2? What to disclose? The transactions covered under section 188. If the transaction is being covered under section 188, all those transactions has to be disclosed in the AOC2 form. That means the transactions which are covered under section 188 means the transaction, either it won't be in the ordinary course of business or it won't be in the arm's length price. Such cases, that transaction automatically gets covered under section 1, gets automatically incorporated in the AOC2. And other related party transactions, the transactions which are within the list of transactions of section 188, but there is no specific requirement as to the reporting. If such transactions are material transactions, then such transactions are also required to be reported. There is no specific definition as to what is material. If we take the definition from SEBI, we have if the transaction exceeds 10% of the annual turnover, then such transactions can be reported. So what is required to be reported in AOC 2 are the transactions which are covered under section 188. The records and registers are required to be maintained. The details to be recorded. The records and registers which are required to be maintained is governed by section 189, and the records are to be maintained in the form MBP4. That is a format for that. And it is said that the disclosures and contracts under section 184, disclosures under section 184 and contracts under section 188 of the Act are required to be entered in the register of contracts with related parties. What all disclosures have been made by the directors in respect of their interest in a particular concern or a company or body corporate, those details has to be incorporated in MPP4 as per section 189. And all contracts or arrangements which attracts the provision of section 188 are also required to be recorded in the MPP4. That is the register of contracts with related parties. That is a requirement of the Act, the section 189. No entry is required to be made in the said register if section 184 and 188 are not applicable. So the transactions covered under section 188 alone is to be recorded in the record MBP4, which is a register mentioned under section 189. The contracts or arrangements with the related party with respect to transactions to which section 188 applies. That is, the related party transactions which are not in the ordinary course of business or not on arm's length basis. Only then section 188 gets hit, and it brings those transactions within the compliance procedures of section 188. Only such transactions are required to be recorded in MPP for the register, which is required to be maintained under section 189. We'll talk about the consequences and penal provisions. That is, if the section 188 or the provisions of section 188 are not complied with, what is the penal provision? Consequence of approval. First, we'll talk about the consequences of approval being not in order. In cases where the required approval has not been obtained prior to entering the transaction, that is, the approval is not obtained from the board or shareholders prior to entering into the transaction, and such transaction has not been ratified, such approval has not been ratified within a period of 3 months, such transaction is voidable at the option of the board of directors or shareholders. So the board or the general meeting has an option to declare such a transaction as void. There is no legality in such a transaction, and if any such transaction leads to any loss for the company, the director or the interested employee is supposed to indemnify the loss if any has occurred, and the company has a legal base to move legally against the director who has initiated such transaction. That is a consequence of approval not being in order. And the penal provision. In case of listed companies, for non-compliance of provisions of section 188, we have a penalty of flat 25 lakhs. And in other companies, a penalty of 5 lakhs has been imposed, can be imposed. It is a recent amendment in the year 2020. Earlier, it was like a minimum penalty of 25,000 up to 5 lakh in case of listed companies and 1 year imprisonment. And in case of other companies, minimum 25,000 up to 5 lakh. There was no imprisonment as such. But that penal provision has been amended, and what came into effect is severe punishment as in case of listed companies who are not complying with the provisions of section 188, a penalty of 25 lakhs can be imposed, and other companies the penalty of 5 lakhs can be imposed. This is another matter why this section has became very important in this point of time. The huge penal provision that may attract if this section is not properly complied with. And the CARA 2016, the format for disclosure. What the question is whether the companies has complied with the section 177 and 188 of the Companies Act 2016, I mean Companies Act 2013, and whether the required disclosure as required by the accounting standard is properly done. That is the question what is mentioned in 2016, I mean the CARA 2016. And what is the format for disclosing such details, such non-compliance? We have a disclosure format which is given in the guidance note to CARA 2016. The nature of the related party relationship and the underlying transaction, we can mention there. What is the amount involved and what is the remarks? Details of non-compliance can be given there. In arriving at such a decision that the company has not complied with the provisions of section 188 or section 177, it is the duty of the auditor to obtain sufficient and appropriate evidence to conclude that that particular company has not complied with the provisions of section 177 or section 188. So it is a duty of the auditor to obtain appropriate evidence. It can be in the form of the policy of the company or the certificates from the internal auditors or the statements from those charged with governance or such other supporting evidence need to be obtained by the auditor before arriving at such a conclusion. So that is a disclosure requirement which is required under CARA 2016. We have seen the transaction which is covered under section 188. We have a summary chart here. The contract, the flow of transaction is like the contract or arrangement with the related party. I mean the 7 transactions which was covered under section 188 subsection 1. Those transactions are getting triggered or those transactions are getting happening in respect of a company. And first thing we have to check whether the transaction is in the ordinary course of business or at arm's length price. That is a primary check we have to do, whether the transaction is in the ordinary course of business and at arm's length price. If that question gives an answer that it is yes, that it is in the ordinary course of business and it is at arm's length price, there is no action required as such under section 188. If any disclosure requirement as per AOC 2 is required, then only we need to do that. Apart from that, there is no action required under section 188. Next condition, if the answer is no, that the contract or arrangement with a related party, either it is not in the ordinary course of business or it is not at an arm's length price. Check whether the related party transaction is getting stipulated. No, the related party transaction is not getting stipulated. There is no action required under section 188. It is not getting covered under section 188. The list of transactions, the particular transaction is not getting covered under the list of transactions, that 7 transactions which we have covered under section 188. It is not getting covered in that. Then also no action is required under section 188. If the limit is breached, I mean, what limit is mentioned? That means what is required for shareholders' approval. That limit is breached, then check whether the limit is breached or not. If no limit is breached, then what we require is the board consent. That's the end. If the transaction is not either, it's not in the ordinary cost of business or not in the arm's length price, and the related party transaction, the transaction gets covered within the transactions mentioned under section 188, and the limit is not breached, then what we need is a pure consent from the board. And what in case the limit is breached? We need a board consent and a prior ordinary resolution by the general meeting. That is a summary chart of section 188. So this chart alone gives a proper idea of what transactions are covered under section 188 and what is the procedure which we have, which we need to comply while complying with section 188. Only the $1 million question is whether the transaction is in the ordinary course of business, or it's not or, sorry, whether the transaction is in the ordinary course of business and at arm's length price. If that condition is complied with, there is no further question as to whether we need to get the approval of the board or something like that. If the condition is not complied alone, we need to check whether that particular transaction is covered under the list of 7 transactions which is mentioned under section 188. That is all the check we need to do, and later on we need to keep a check on the limit, whether it exceeds the limit what we have allowed limit. If it exceeds the limit, we need to get the approval from the shareholders. If no, the limit is not breached, the board consent alone is sufficient. We'll do one more thing, what we have skipped earlier, talking about the audit committee. That is section 177. We have audit committee which is governed by the provisions of section 177. The conditions or the threshold conditions under which a company is required to form an audit committee. Every listed company is required to form an audit committee. All public companies with a paid up capital of rupees 10 crore or more, all public companies having turnover of rupees 100 crore or more, all public companies having in aggregate outstanding loans or borrowings or debentures or deposits exceeding rupees 50 crores or more. That is the threshold condition where audit committee is required to be formed. The company can voluntarily form an audit committee. In case the company is forming audit committee voluntarily, then the company is required to comply with the provisions of section 177. So what is the provisions under section 177 says? We had an earlier we had a discussion on a phrase that all transactions with related parties are not related party transactions, but all related party transactions are transactions with related parties. So what is covered under section 177 is the audit committee is required to approve. A prior approval of the audit committee is required in all transactions with related parties, and specific approval is required in all cases. Mere recommendations from the audit committee won't do any benefit. Specific approval itself is required. So section 177 doesn't make any reference to section 188. That itself makes the intention of the law clear, that the audit committee is required to approve all the transactions with related parties and not just the related party transactions which are covered under section 188. So a prior approval is required to be taken from the audit committee for all the companies who are required to constitute audit committee. What if transaction has been carried out without a prior approval? What we have already seen, it can be ratified within 3 months. If not ratified, or in case where prior approval is not obtained, it is voidable at the option of the committee. And in case where the company has incurred loss due to the action of any particular interested director or employee, the company can sue against him, and he is supposed to indemnify the loss which has occurred to the company. That is all about the audit committee. And this is about the omnibus approval which the audit committee can grant in respect to related party transactions. So that's about section 188. If you have, so do we have time, sir?
So no problem. It's now it's a 5. How many time required further? 5 minutes, sir?
10 minutes, 5 to 10 minutes.
No problem, Sebin. You continue, please. No problem.
So we have completed about section 188. Then we were talking about section, AS 18, and we will be taking a glance at what the disclosure is required as required by the AS. What all things need to be disclosed as per AS 18. And disclosure as required by AS 18, what all things need to be disclosed. It is an exhaustive list as per AS 18. The following details has to be disclosed: the name of the transacting related party, the description of the relationships, the description of the nature of transactions, the volume of transaction either as an amount or as an appropriate proportion, any other elements of the related party transactions necessary for an understanding, the amount or appropriate proportion of outstanding items at the balance sheet date, the provision for doubtful debts due from such parties at the balance sheet date, and amounts written off or written back in the period in respect of debts due to related party. So these are the disclosures which are required to be made as per AS 18. Minimum requirements are there. So for a better understanding, I have compiled the views of FRRB, Financial Reporting Review Board, on the disclosures made by several companies in respect of AS 18, and what are the shortcomings, or what all are the issues which was noticed in respect of disclosures made under section AS under accounting standard 18 in respect of related party disclosures. What they have said is, the first issue is that from the related party disclosures given in the annual reports of some companies, the following has been noted: the name of the related parties and the transactions that have taken place with such related parties have been disclosed, but the nature of the relationship with them has not been disclosed. So the disclosure requirement has not been met. In certain cases, the names of the related parties have been disclosed along with their designations: managing director, full-time director, and that all, and not the relationship. It has also been noted in few cases that the transaction with the KMP have not been disclosed. So it is one of the issues which was pointed out by FRRB in their publication in respect of AS 18. Issue 2. From the related party disclosures as given in the annual report, it has been noted that the volume of transactions has been disclosed, but the nature of transactions has not been disclosed. This is another issue which was pointed out, and the solution is that, the base for such a disclosure is that paragraph 23, clause 2 of AS 18 provides that if there has been transactions between related parties during the existence of a related party relationship, the reporting enterprise should disclose the following. It is specifically mentioned what all things are required to be disclosed as per AS 18. And if we are not complying with that particular disclosure requirement, there is a non-compliance as to the accounting standard. So that is the issue there. they have not mentioned the relationship between parties, or they have not mentioned or described about the nature of the transactions. So that is a serious issue of non-compliance in respect to accounting standard. And another case is that the name of the holding companies have not been disclosed in the related party disclosures. In respect of that issue, it may be noted that paragraph 21 of AS 18 states that name of the related party and nature of the related party relationship where control exists should be disclosed irrespective of whether or not there have been transactions between the related parties. This point was highlighted at the time when we were talking about the comparison of section 188 and AS 18. That in case of section 188, if there are no such transactions which attracts the provision of that particular section, there is no disclosure as such required. Okay, if there is no particular transaction which attracts the provision of section 188, there is no particular disclosure requirement need to be met. But in case of AS 18, if no transaction is not there, okay, fine, the transaction details need not be mentioned, or there is no requirement as to mention that there is no transaction between the related party. The requirement is that if there is any relationship where control exists, it should be disclosed irrespective of whether or not there have been transactions. So that is a point to be made clear, that in case where there are relationship which the relationship gets executed only purely based on the control mechanism, then the company is required to disclose such relationships, the name of the party and the relationship, whether the holding, subsidiary, or likewise. All other related party transactions disclosures are required only in case where transaction do exist. So that's the point I want to highlight. Thank you, sir. Thank you.
Thank you, Sebin. It's a beautiful presentation, and I really congratulate you and all my compliments to you. You have traveled through its entire length and breadth of the subject, and I once again thank you. Sebin, there are a few questions are there in the chat box. Can you please? And the members, if there is members and students, now you have the floor is open. And if there is any specific doubt, you can ask. Some questions are there in the chat box. Sebin, can you please?
What is F bar, C bar, BC? So that's a, I mean, for easier preparing the slide, I have given as firm, corporate, or body corporate. That's the expansion of F bar, C bar, BC. That is expansion. That's around the questions, I believe, sir. Next question, that where are the disclosures to be made under section 188 and AS 18? I think we have discussed that in detail.
Okay.
In respect of section 188, disclosure is to be made in AOC 2, that is statement annexed to the board report, and AS 18, the disclosure is to be made in the general purpose financial statement. That means the notes to financials. You may note it that.
Okay, members, if there is if there is any other question, you can ask. Otherwise, we will conclude it. Sebin, once again, I thank you for the wonderful presentation. And now I request CA Najib Sadiq to kindly propose the vote of thanks, a formal vote of thanks. Please, Najib.
That was a wonderful session, Sebin, on this important topic, related party transactions. You have done a very good job. First of all, I would like to thank our beloved chairman for giving an opportunity to deliver a vote of thanks. Respected distinguished speaker, CA Sebin Mathew, a very good friend of mine, Chairman CRG sir, senior and fellow members, and my dear friends, warm good evening to all. CA Sebin Mathew, you're actually a wizard on Companies Act and company audit right now. These 2 hours of seminar really shows how much grip and knowledge you have in this topic. And the lecture was actually so crisp and clear that you have covered all the topic, covering all the definitions explaining everything, each and every sections one by one, and giving with live examples of what will happening, how which we don't give disclosures and all, and what are the things need to be kept in mind when to look after what is an ordinary course of business, and vagera vagera. So that was a really good and marvelous presentation, CA Sebin Mathew. And I think you should often start teaching company lessons to share your knowledge and experience to all our budding CAs. And I, on behalf of Kannur branch of ICAI, SIRC of ICAI, express my sincere gratitude to CA Sebin Mathew for accepting the invitation and handling the session so well. And thank you, Sebin, for the wonderful presentation. Also, I extend my vote of thanks to all my members and my friends who are present and actively participated in the today virtual seminar. Have a good day.
Thank you, Najib. Thank you, Sebin, once again. Thank you for the presentation. Very marvelous presentation. Thank you, and thank you all my dear members and students for the participation. Thank you.